Fundamentals don't matter. Pumpamentals will carry the day. Fundamentals don't matter. Pumpamentals will carry the day.
Shout out to the Discord member who created the Pumpamentals song. I mean, that's got to be the anthem of the trading and investing part of this channel. Speaking of which, I wanted to take a moment out here and reflect on a little bit on why I'm even doing this and why I'm posting these videos. And you know, the trading and investing aspect of what I'm doing is a critical component. And the reason is it allows for financial freedom and allowing you to break away from the system and become your own boss and not be held slave to, you know, some machinery. And you know, the thing is, I thought that getting out of the corporate machinery and building startups was a way out. But you know, what I found out in startup world is just there's another machinery. It's just a different machinery, but it was the same hamster wheel that you were on. You know, you were trying to get, it was the same process, just different, right? You had to get pre-series funding, then series funding, then it was the same thing. And you know, when you're able to generate an income stream that is completely separate from any machinery, right, such as investments, but there are others out there, it allows for a financial freedom that, you know, you can basically be and say and do whatever you want to do, which is immensely powerful and part of actually a larger thing I'm trying to do, which is the whole FoFty thing, which is to actually, you know, escape from this simulation essentially, right? Which is why I wrote this manuscript, and I'm actually starting a respawning process back into the simulation with a few people this weekend. And that's the big picture thing, right? Of which financial freedom and the ability to do whatever you want from that standpoint is a critical component. So that's why I've spent a lot of time recording investment and trading videos lately. But I realize I will also start recording FoFty general videos as well on life itself and the, you know, the path I'm taking over there. And so I'll start recording you know, 2 videos a week, I think, one on trading and investing and the other back to the core and the root of the FoFty channel itself, which is about life itself, living a FoFty life using the FoFty principles. So having said that, let's also take a step back with the investment and trading side of things and understand where we're coming from and what the big picture is. And the big picture is, I mean, this is the biggest picture, is that we have essentially hit escape velocity, right? Now, this is a crazy chart because, and we do have data, but it goes back all the way to 1800, right? And what we see here is basically since the Nixon deal, where we got off the gold standard, which means government was able to print fiat money as much as money as they want out of thin air, we've essentially skyrocketed, right? And this is no surprise. Of course this was going to happen the moment you cut the constraint and allow you to print money out of thin air. Ever since then, we've just had this, you know, parabolic rise, which clearly is just going to go vertical. And here's the thing, this is a many decades long situation, right? So we have to keep that in mind. We're not looking at a day-to-day, month-to-month, or even year-to-year type of setup. We're looking for signs and clues where this really can't continue too much longer. And that's what really, so, you know, if you take this in totality and look at, you know, the time horizon ever since this happened, we're talking about in the 70s, so that's like 50 years, right? We're 50 years into this crazy experiment. And then think about how your life is in terms of how many more years you're probably going to live. For me, I'm 50, so, you know, think maybe another 30, 40 years if I'm lucky. So in another 30, 40 years, do I think this is going to happen? And I don't think so, right? I think, and I'll show you why, the signs are there that this is really reaching the breaking point, and we're closer to the end now than in the beginning, that's for sure. And I do think that in my lifetime, this is all going to end. And it's such a big change that's going to happen when it ends that we have to keep that in mind. That is what we're preparing for here, right? And that's how I've parked different parts of my essentially net worth in different asset classes to prepare for this. One of which is the trading account in equities, but not only that, right? So why do I think that, you know, we're closer to the end? Well, look at what's going on. You know, when you see, we have it's been okay, right? It's been okay going down. These are yields. So how much it costs for basically governments to go into debt, essentially, right? Their own long-term debt. How much the interest rate is that the market is demanding for these big government debts, right? That controls basically the cost of money for the government. And in essence, we had been, if we extend this further out, we had been just going down, 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 down until basically something happened in 2020. And what happened in 2020? Now, I've talked about this before, but what happened in 2020 is essentially COVID. And that changed everything. Now, what happened? What happened in 2020? You know what happened. It was COVID. And what that did is it spooked, because we all thought it was going to be the end of the world. I mean, there was a moment where we didn't know what this disease was, this pandemic, what it was it like, the Great Plagues, like the bubonic plague type of thing? I mean, we didn't know. And so the central banks essentially just totally panicked. And that was the blow off top, in my opinion, for the central banks in terms of printing money. That was the blow off top for the central banks. They hit the nuclear bomb button and unleashed crazy amounts of money printing, which we even had money directly printed by the central banks going directly into your bank account in your back pocket. We know that as a stimmy check, right? That is it. When you print money and stuff it directly into the consumer's back pocket, that's it. There's no more than that, right? And so that was the blow off top for central bank money printing. The end, the blow off top and the end. You can't do more. And because of that, the markets started rebelling, right? The bond markets started rebelling and saying, look, that's it. You've accumulated too much debt. Now you're going to have to pay me more money, in other words, higher interest rates back to me, if you're going to make me borrow your debt, because it's over, right? You just went way overboard in printing. You gotta give me more money if I'm going to give you more debt. And that's basically the entire, and that's basically been going on ever since 2020. Look at this, nonstop, right? And everything that happened between 2020 and 2025 has done nothing to stop this rise. And as I said before, nothing. Whether the Powell and the Fed raises or lowers interest rates, it rose. Whether or not there is risk on or risk off in the equities market, it rose. Whether or not inflation came in hot or cold, it rose. Whether or not Trump's tariff trade was on or off, it rose. Literally, whether or not the jobs report, which we'll talk about, was hot or cold, it rose. Whether or not there's concerns about an incoming recession or there's no recession or anything else, it didn't matter. So what I'm saying is all the traditional influences for long-term yields that traditionally would move the markets have no bearing anymore. It just keeps going up. And that is a clear signal that we are closer to the end. The market is basically rebelling, right? Saying the main issue here is the amount of debt you have and a lack of any plan on how to curtail and deal with it. That is what the market is saying. All the other stuff that traditionally would change the yields and influence the rates have been pushed aside as footnotes. And we have evidence of this, right? I just explained to you, we've seen now since 2020, 5 years of evidence of none of the other stuff mattering anymore. What more evidence do we need? Show it to me. There is none. Now we have the United States government, right? They're stepping in and buying, the Treasury is stepping in and buying their own bonds, right? So this is the end, right? So because Powell isn't cutting interest rates and, that whole thing going on because he thinks he's Paul Volcker, the Treasury has no choice but to buy back their own, they're buying their own debt, right? With whatever budget they have remaining in the coffers in order to try and keep the interest rates down so it doesn't explode higher. And That's literally left hand, right hand. I mean, that's not even left hand, right hand shenanigans. That's right hand, right? You're buying your own debt, which is something that the Japanese government has been doing, and we'll talk a little bit about that and how it's going for them. But essentially, a record amount was bought earlier in the week, and you see the rise, general trend and rising of the government buying its own debt, monetizing its own debt directly. And this is not a good sign, right? This is the sign of final desperation. This is why we know it's going towards the end game. And CDS. So this is credit default swaps on the government debt, meaning, and this is funny because who's going to this is insurance in case the U.S. defaults, and I wonder who's going to pay this insurance. Actually, I mean, we know who they are, but it's just a funny concept if you think about it, right? Because the U.S. government defaults, that's it, and it's rising now. It rose earlier before, right, when we had that scare earlier, but we're reaching high levels again, and we're probably going to keep seeing this rise, right, as the markets become more and more concerned of a possible debt. No matter what Besant says about the U.S. will never default, which the U.S. already has defaulted 3 times in its past, right? So people who think, oh, the U.S. has never defaulted, no, it's defaulted 3 times already, right? And that goes all the way to the initial currency of the United States, which was the Continental, which they printed too much out of to fund the war back then, and it defaulted, and then they created the U.S. dollar. And that defaulted as well. There was the gold default, right? And again, the 1970s, where the U.S. defaulted on its gold, and that's why Nixon said, "No, Europeans, you come in looking for your gold. We're not going to give it to you. There's no obligation for us to give it to you." And they defaulted because this is that big question: how much gold does the U.S. actually have in its coffers? Anyway, the U.S. has defaulted before, right? And there's a concept of a hard and a soft default. I'm talking about hard defaults. There's also a soft default, which you essentially default by hyperinflating your money away, and your money becomes worthless. That's also a default at the end of the day, and they call that a soft default, which may be something that we're staring at. Now, why are we panicking? Or why is the markets panicking? Yeah, we want to call it panicking, but, really concerned. Well, this year, right, 2025, we have this spike, right, where U.S. debt will have to be rolled over. And the existing, this huge amount, right, and we're talking about trillions of dollars, $7 trillion of dollars coming due in 2025, was bought at a really low interest rate, And now that we're going to have to roll it over the government, it's going to be at a much higher interest rate because interest rates are higher today. Right? Because of, I just explained, the yields have gone up because of concerns about the total debt. And so when they roll this over, it's going to be a lot more expensive. A lot more expensive. We got $7 trillion, a huge amount. This reminds me of what happened with the 07-08 debt debacle. Back then, it wasn't sovereign debt, it was commercial debt for mortgages. And if you remember back then, there was the adjustable rate mortgage, 3, 5, 7 years, where people bought at like 0 interest rate, and then after 3 years, it would adjust higher. And, the whole point was because housing prices kept going up, it was okay for it to adjust higher because you would flip it and make money within 3 years anyway because you bought it at 0 interest rates. Well, of course, we know what happened. Housing prices, that whole thing popped. And so when the 3, 5, 7 year mortgage rates had to adjust higher, that just was, the end, right? It caused people to go bankrupt and foreclose because they couldn't afford the higher mortgage rates when the time came for it to adjust higher. Well, this is essentially the same thing, right? Because what's going on is we have a huge a wall of debt coming home to have to be rolled over. And just like the adjustable rate mortgage, the rates are much higher this year, right? In 2025. And so that means when it rolls over, it's going to adjust to a much higher rate. Just like what happened with the ARMs and the adjustable rate mortgages back in 07-08. Except the difference this time is that it's not commercial and mortgage debt. Now we're talking about sovereign debt, right? And this was the last episode, who bails out the central banks. It's essentially the public. They'll get bailed out through hyperinflation eventually if this continues. So we'll see what happens, but this is coming, right, in the second half of 2025 when this comes due. And I'm not sure how they're going to pay this off, right? This is essentially the adjustable rate mortgage nightmare that we saw in '07 and '08. Now, if we want to see what happened to Japan, which has been buying its own debt for a long time, well, they're stuck with a crazy amount of unrealized paper loss. Now, this is unrealized, right? So it's paper losses, but they're 28.6 trillion yen negative, which is still hundreds of billions of dollars. I mean, okay, I'm not going to turn this into a watch out for Japan episode, but watch out for Japan. Okay? There's something going on over there that's really not good, and they're stuck in the middle of this tariff negotiations, which they're not going to like accept because they're just stuck between a rock and a hard place. So going back to the US, right? What we're looking at this year is, if we look at the 30-year yields, it's forming what potentially is a cup and handle pattern. And the longer the time period of a cup and handle pattern, the bigger I am a watcher of it, because they tend to resolve, and we may shoot this up this year, right? Second half of this year, we may, even now, right? We had gone down, and the government, as I showed you, bought a ton of bonds, monetized it, and it lasted for like very short time before it started going up again. So we can now add to the bond rising, no matter what happens equation, the government buying its own debt. So government buys its own debt, Treasury buying its own Treasury bills, and guess what? That lasted for like a few days, and bonds just kept going up. It's like a drug addict. You need you build resistance, so the amount of drugs you take needs to keep going up for you to get the hit, the feels, right? And the Treasury buying 10 billion, which was a record earlier in the week, did nothing. It bought them 2 days, and now it's back up over 5% again, 4.5 in a 10-year. So you need a bigger hit, right? And this is what I mean. This is that doom loop that you enter. And we are looking at this formation over here, and look out, if this goes up, we're looking at 8%, 10%, 15% mortgage rates, and the housing market, which is, we'll talk about some other time, that's beginning to implode as well. So going back to the big picture, what are we doing to prepare for such a thing? You know what's so interesting is, look at this. This was 1970. Same time when the Nixon deal happened, and we've gone into full bore fiat money printing mode. Ever since then, and this is old, right? This ended in 2015. Now we're up to over 100,000 actually, right? Kilogram for gold. This has gone up like this. But I pulled this one up because it goes all the way back in time to show you that if you compare stocks over time, it's like there's nothing like gold over time, right? And that is why I have a huge amount of my assets in physical gold bars, for this reason. And this is just it already has gone up, right? We're already over 100,000, almost double of what when this chart was shown. And it's just going to go up along with its new entrant cousin BTC, I think, as we enter this final phase, right? Which, as I said, will take some time to develop, but when it develops in our lifetime, you better be prepared, because you're going to lose everything if you're not. Now, the other thing I wanted to mention that we saw happen this week, is what happened to silver. And look at this, my friends. I've always said silver has to catch up, and there's a gold to silver ratio chart, but once silver catches up, and I think we finally have broken out of 3 decades worth of silver money, funniness by the cartels holding it down. It's gotten up over 35, and this week stayed over 36 the past day. If silver breaks out, which I think it did, that initial breakout signifies we are entering the second phase now, right? Where now the other precious metal markets and the miners are catching up to gold, which has already rocketed up in the past couple of years. So now we're in phase 2, where the other assets in precious metals and the miners are beginning to catch up. And once we enter phase 2, that's that signal that the danger zone is approaching, right, of the debt market. We are approaching the second half of this year. We are approaching now the danger zone, for the reasons I showed, of the debt market debacle. And we see more and more people talking about it, between Ray Dalio and Jamie Dimon, and there are going to be more people who are going to come out and just say, like, look, we're facing a wall that we don't have an answer to. And the yields keep going up no matter whatever we do. Nothing, no matter what, not anything. keeps going up. Meanwhile, 7 trillion rebalancing coming up. We got to roll that over at much, much higher yield rates. How are we going to solve that? Now, the jobs data came out on Friday and it was a beat. And the market skyrocketed. Woohoo, Pumpamentals because of that. But look at this. This gap, right, is essentially the gap of reality and Pumpamentals. And, I mean, you know, the game continues, right? So stock markets trades on the headlines, but then the headlines are always revised downwards months later. And we see that happening again. So on Friday, and I posted this on our Discord channel just, for fun, but so what happened on Friday, right? The market jobs number beat 13,000 more than expected. Woohoo! Let's go to the moon. Oh, by the way, April was revised down from 177 to 147, down 30K. And March was revised down from 185 to 120K. Huge revision down, right? The total revision down was 95,000. If you combine these two, we revised down 95,000. But we were up 13,000 above expectations. Dude, that's a net of 80,000, 82,000 down. Make no mistake, this is going to get revised down again. You see how stupid this is? This is a bunch of Pumpamentals, essentially, right? Now, if we believe that this number actually is a lot lower, which it probably is, given the revisions that are going on every freaking month, it probably, given the ADP numbers, which was a measly 35,000, which was hugely lower than the 120, 30,000 they were expecting. This is Pumpamentals, right? And they're going to revise this downwards. Probably it was under 100,000, and unemployment is probably higher than this 4-point low number that they keep talking about, which means the economy is also beginning to unravel. At the same time, the debt market is going to bomb out. So this is a double whammy. And, all this other stuff, and I'm not even going to talk about the Trump, Musk, divorce proceedings and even the tariff stuff, right, is all a sideshow actually compared to what's really happening, guys, under the engine cover. And when you see stuff like this, you best be prepared of what's going to be happening. Now, when we talk about the equity markets, who's leaving? All the foreign investors are leaving. This is a record amount, right, in the past few years. They're going away. And it's not just the stock markets that foreigners are leaving. They're leaving the bond market. They're not buying bonds, right? Some are even threatening to sell U.S. debt, treasuries. They're leaving that. They're also leaving the U.S. dollar currency, right? Look at the dollar getting weaker. So you got bond yields ripping up higher because one of the reasons is foreigners they don't believe in the U.S. debt anymore, right? So yields are going up. It's because who's left buying it? It's just Americans buying their own debt. Dollars going down because they don't want dollars anymore. Dollar keeps going down. Whatever profit you made from trade internationally with the U.S., your profits go down with the dollar down like 10% almost. That means whatever 10% profit you made trading with the U.S. is washed away when you convert it back to your own currency. People don't want dollars, and now it's clear that stocks are also being sold by the foreigners. So everybody's basically saying, we don't want U.S. stuff anymore. U.S. assets? No, thank you. And the interesting thing is the stock market continues to go up even though foreigners are leaving it, right? And the reason is, we're probably here, and the return to normal can be a double top, right? As was the case in the 07-08 double top. Return to normal is actually marginal higher top, right? Where everybody thought, woohoo, return to normal go up. So are we here or are we here is the question, right? Many people today are saying, well, we're going to make we could make new all-time highs. But even if we do, this is just a rounding. This is what happened in 07-08. Are we here and we're gonna make a marginal higher, new high and go down? Possible. Or are we here? We're almost gonna make a new all-time high, but fall short, and then we go down. The point is, it doesn't matter, right? And again, like I said, this is like over a multi-year period. This is a rounding, topping process that we are entering right now for the reasons I said. And to get lost in the day-to-day or week-to-week keep in mind where we are. Don't be picking up pennies in front of a huge steamroller coming at you, right? You're going to get flattened. So it's okay, right? Just keep the big picture in mind and you'll understand that everything's okay. Now, why is the stock market continuing to go up if, right, and this is the stock market, why is it going up if even the foreigners are leaving? You know, bond markets going down, right? Dollar going down. Why is stock market going? Well, the answer is simple. Stock market is the easiest and largest thing that your mom, Joe, and Pop and retail trader trades. Buy Ron Hood account and trade this, right? It's sexy. It's easy to trade. They don't trade bond markets, right? Retail money doesn't trade bond markets. They don't trade the current FX markets, right? You need huge amounts of money to trade FX market. That's for the professionals. The professionals live primarily in the bond and FX market. That's why it's called the smart money, right? Smart markets. The dumb money, the retailers and the casino gamblers, they live in equities, right? That's where it's easy to trade. And that's why even though foreigners have been leaving, this has been basically all local retail gamblers in the US equity markets pushing this up. That is what's going on right now. And I don't have faith in local US gamblers. I put my money on the international professional traders in the bond and currency markets, which, by the way, are a lot larger than the equity markets in terms of overall market cap. So zooming in a little bit further, you know, where are we at right now? Well, I think we're still in a Wyckoff distribution. Now, the Wyckoff distribution was what happened at the previous all-time high. We just meandered around as, you know, more big money kept unloading into the, you know, local retail gamblers until the gamblers kind of finally ran out of dry powder and they just let it rip, right? And so here we are. We're kind of like, you know, on Friday made a marginal high over here, but we're kind of still in this distribution zone, right, at this range where I do believe the big money is essentially drip unloading and not letting it go too low so they can buy the dip and come back on before they unload, and playing this game of unloading until basically, you know, they get to the point where there's no more dry powder for the dip buyer retail gamblers in the local US equities market buys anymore. Then they're just going to unload and dump the rest when they think it's over. And that's what I think is happening and probably will continue to happen until it resolves, right? That is what I think is going on. And here it is in a little bit more zoomed in. You know, this is basically the Wyckoff distribution pattern. You know, we went up, we had BC, we went down to the range. So this is a range over here. This is the same range over here. You know, and then we go up, marginal new high in the UT, upward thrust, you know, a marginal new high, and then you go down and meander, go down and meander, and then go back up to the range top, and we went back up to the range top, maybe make a marginal new high, and I would expect we kind of chop around here, you know, with these small movements, and then we'll probably go down to the range bottom again, the range bottom is somewhere around here, like in this rectangle, so we'll probably go at some point, you know, make a new high, chop around, make whatever, drive this down. Then we can't make it back up, and that's when they'll unload the rest. I think that's what's going to be happening in the next maybe week or two, even. Just more distribution in this Wyckoff distribution phase before we see. Now, if that doesn't happen and we shoot up and make challenging you to previous all-time high, making marginal all-time high, like I said, that's what happened before, right? You could have a double top like in 07, 08. It's only if we break the all-time high, retest it, and just continue on higher, compared to the last all-time high, when we can then say definitively, okay, postpone everything, we're going up higher, push out the time frame before this all rolls over. And it is possible, right? Look, nobody knows the future, and I don't either. I adjust to what things are happening. But the overall thesis and the overall reason why I'm doing what I'm doing, I left my job, I'm preparing for what's going to come, I want to take control of my future, from at least the financial component point of view and the overall life picture remains the same, right? Because I'm like, I guess, the Chinese here. I'm like, you know, I'm planning for, you know, not the next 4 years or next term. I'm planning for the rest of my life and my family's lives, decades, right? 20, 30 years, what's going to happen. That's what I'm planning for. And that's what I believe you should be planning for as well. So having said that, I look forward to seeing you in the next episode. I will be dropping the next episode, which is more about FoFty itself, which is beyond just the trading, of which, as I said, is an important component of financial freedom, but also there's other forms of freedom in life besides financial that you must take control over, right, in order to actually be in control of the simulation and not be controlled by the simulation like an NPC. So until then, have a good one.